Let's make sure this is. Hi, everybody. Welcome to our CMBS 3030 call for today, June 1st, 2021. Can't believe it's June already. I've got sitting here with me Will LeMay, who's head of our workout team at First Service Solutions. And Will, why don't you, for those that haven't met you before, give a
Hi, Will LeMay. I've head of workouts here at First Service. Spent the last 2 decades or so in lender shops in all forms of asset management, and doing workouts. And recently joined AND to help borrowers from that perspective. So I'm happy to be here.
Yeah, recently meaning a number of
months
ago.
A number of months. That's in four months ago.
Yeah. And together we've got a combined, 50 some plus years experience in this industry. So here's what we wanted to cover today. And I really appreciate all of you joining the call. If you, by the way, have a question or anything, I'm sure you've all done this before, but feel free to type it in and we'll take the calls as we go through. We want to talk about the type of relief that's been granted to date on CMBS. Most importantly, this is the focus of today's call, what it is those forbearance agreements likely contained or will contain if you're still in the final stages of approval, what the servicers are, now that forbearance, those terms are coming up or are up, what are the servicers doing now, and what are your options as those forbearance agreements are coming up? So we didn't rehearse any of this. We're going to talk. Luckily, we're sitting here together, so we may interrupt each other here and there, but that's fine. I hope everybody can follow fine. But let me first recap the type of relief that we've seen in the industry. So all the COVID relief is always for at least commercial real estate, CMBS product. But I think I even heard today, even bank product is the same way. But all the relief is in the form of a deferral. So you didn't get away with not paying a payment. It's actually that one payment is now due at a later date. And so so all the deferred amount has to be paid back. So if you got 3 months or 6 months of deferral, you probably have already got the deferral, paid it back, and maybe okay. Some of the more common longer term, if you will, in air quotes, forbearances were about 12 months. So you started April 2020, you got a 12-month forbearance, and now on April 1st, 21, you were staring at a full payment being due and maybe starting to repay the deferred amount. And those deferred amounts are repaid over a 6 to 12 to 18-month period.
Right, and I think there were some creative ways that the math worked. It could have, when we say deferral, we meant anything from your principal and interest. We had folks who had their reserve deposits waived temporarily. That's included in deferral. We had servicers allowing borrowers to use money that were in the FF&E reserves, and for hospitality, sometimes TIP reserves. They allowed them to temporarily use that money to make payments and, quote, stay current. But that was all deferral. So included in those forbearance agreements were requirements, most often requirements to start refilling those reserves at some point in the future. And future, for a lot of folks, is about now.
Yeah, that's partly why we're doing this. So the terms in the forbearance agreement, so let me just pause. There were about 1,200 forbearance requests that went into the servicers. We per the data we can pull off of Trepp and Bloomberg, it looks like about 1,200 deals had a label of COVID-19 relief. About half of those have been documented and the other half are in the final stages and documentation. So you may be hearing us today and saying, well, I haven't seen my forbearance agreement yet, it's not approved yet, and you're not in the minority. It's about half and half. So let us talk to you about what's in those forbearance agreements and what you likely gave to get the forbearance. We'll just kind of go through them. But number one, typically all the fees that were waived, your default, interest, your late fees and all that, were all conditionally waived and are due upon any future default. So if they waived in essence $1 million of default, interest, and late fees, be really aware and focused on the fact that those all become due and payable upon a default of the forbearance. And many of those, we didn't talk about the guarantee, but the deferred amount was almost always required to be personally guaranteed by the guarantor. And sometimes even those fees that they waived were part of your guaranteed repayment if you default.
That is something you want to check very closely in the forbearance agreement, because it sometimes it was thrown in there and sometimes it wasn't. And it's really hidden in the definitions of what the deferred amounts are, because surely almost 100% of the time, if you had your principal interest reserves deferred, then that's going to be covered under your guarantee. But there were quite a few of those where the deferred amounts were also defined as those conditionally waived fees, including any modification fees you might have had waived. And default interest, that's your real big number that could come back. Because unfortunately, a lot of you incurred default interest because the only way to get relief was to go into default, and the default interest automatically started accruing.
And the reason it got so big is because we had to wait so long,
Took so long
in front of the special servicer to get that deal. So, the default interest really accrued and became a big number. The other thing that they generally required of you to enter into this forbearance was that they would require you to potentially enter into cash management. Every now and then they would agree to get you in cash management, but would push off or waive the trigger to go into a cash sweep. And so, but again, that was dependent upon no future defaults. If you got cash management waived as part of your forbearance, I would say with most certainty, it's conditioned upon no future default. And if you do default, you're immediately in cash management. And then other things, and maybe
let's talk 1 second about why that's important, because a lot of folks, I assume you're here because you've never experienced this before. The defaults were new, and why sweep versus cash management's important, because under a cash sweep event, they take all your money and they keep it, and they don't apply it to anything, and you don't really have any ability to get any money out. Under a cash management situation, simple cash management, they apply a waterfall, and so you at least cover as much of that waterfall amount as you could possibly cover, and you might have to come out of pocket for some things, but you don't have to come out of pocket for everything. But under a cash sweep, you could potentially have to come out of pocket for everything, which is dangerous. And a lot of folks don't realize that that's a poison pill sitting there.
Yeah, that is definitely a poison pill. And other poison pills that are buried in these documents, or not so buried, but you often are agreeing upon these springing actions. If you do default again, we servicer have the right to immediately put a receiver in. Well, some borrowers argued and said, well, they already have that right. And maybe that is true. And I'm not the lawyer here, Will is, although not a lawyer for our firm. But also I want you to talk a little bit more about what people might have agreed to with the deed in lieu or the springing receiver motion.
Under your loan documents, sure, your existing loan documents, the lender always had the right to exercise remedies. And depending on what state you're in, that could mean going to court and pursuing judicial foreclosure in judicial foreclosure states, or non-judicial foreclosure, which is easier, states like Texas, where you can go and just exercise the remedies. But you always had defenses to that. What these documents did was they had you up until the point of any new default. So all your prior defaults, everything they're forbearing, everything they're deferring, in order to get that, you a lot of times had to waive those defenses. So even in judicial foreclosure states, which are typically more borrower friendly, what you've done a lot of times, now whether it's enforceable in court or not is something you have to fight about, but at least on paper, what you've done is you may have waived a lot of those defenses to make it easier and quicker for lenders to act on those defaults that they have forborne. The other point there is that in order to enter into this, you had to agree that you were in default and that you didn't have any defenses. So you put yourself in to get the relief you needed. You've likely, at least on paper, agreed that you were in default and that you didn't have any defenses to it, and allow the servicer or lender to then go in and exercise remedy ostensibly more quickly and for less expense to them.
Okay, so now let's get to the point where you know the kind of relief that was granted, you signed your forbearance agreement or are in the process of signing it, you agreed to these things, and you're at the end of your forbearance terms with which almost everybody is about at this point. What we want to talk about is, number one is, what is a servicer's, I don't know the right word, servicer's approach or attitude at this point? Let's first, to contrast it, let's go back to, and I think you worded it perfectly earlier, Will, in our earlier conversation today about how in, April, May, June of 2020, the servicers were viewing, everybody in the world was viewing the COVID issue as, oh my God, who knows what the future is.
We were in a national crisis. It was an emergency situation. Who knows what's going to happen? This thing might be over in a month. It might be over in 2 months. It might be over in 3 months. We don't know. And they certainly at that point, I believe, did not want to look like the bad guys in a time of a national crisis. Well, fast forward a year.
Yeah.
And so they gave relief. They were willing to kick that can down the road and say, let's see what happens. We certainly don't want to be looking like the bad guy, so we'll give you some more time to pay. And that's really all they did, was gave you more time.
And now it seems like when you look around, first of all, we're at the point today in the industry for COVID relief that we were in essence a year ago. Meaning, a year ago, we didn't know, none of us did. We didn't know what the servicers would and wouldn't do. We didn't know if they would foreclose on you in April of 2020 or not. We were pleasantly surprised and pleased that their business plan turned out to earn fees as opposed to foreclosing on everybody. Right. So they earned fees. They kicked the can down the road. Here we are. The world, if you look around, I just went to a conference in person for the first time a couple of weeks ago, the Hunter Hotel Conference. And I can tell you that everybody, I would say, around me, I felt like the negative person, I'm usually not in the crowd, but everybody is drinking this Kool-Aid that is everything's good, we're fixed, we're done, COVID's behind us, life is great. The occupancy numbers on hotels are going up, the default rates are going down. Life is good. And
people are back in restaurants.
Yeah, traveling, we got Memorial Day weekend, everybody just traveled. Life is good.
You watch television and the NBA playoffs are going on now, and you see arenas at 90% of capacity. So Disneyland is open.
Yeah.
And so you folks generally have the belief that, and you see in the newspapers, despite some warnings that you still get, things seem to be getting back to normal, but think about what that means. And I don't have to tell you guys this, you're running these properties. Back to normal simply means, even if we were 100% back to normal, that means you could pay what you had to pay before and make a little money off of it. Now you're going to be faced with paying everything you had to pay before, plus paying back all that you didn't have to pay. So we have to be back to better.
Yeah, that's okay. Some cases
double normal. And I think everybody agrees we're not there yet and may not be there for a long time. So
that's the question.
What happens,
right? So we don't know for sure how servicers are going to react when you go back and say, okay, I appreciate the 12 months you gave me. Here I am now. I need a little more time. Well, we have, on behalf of owners, gone in a couple times so far and made that very request. We're not getting a good reception.
That's right.
They are willing to potentially push out the deferred payback a few months, but they are not generally right now willing to grant additional relief. And that's why we covered the market view earlier, because they are hearing, you know, things are good. I mean, you got to, at this point, I did my part. I'm not too worried about any headline
That's
risk
right.
anymore.
They're not going to look like the bad guys anymore.
I gave them a year, you know, I gave you a year so let's talk about what you should do. So you need to write on wherever your tickler mechanism is. Mine's a big whiteboard in my office, but I would put that date of the expiration of your forbearance on somewhere way in front of you. And well before that date comes and goes, you should be aware of, first of all, approach the servicer. We're happy to help you. Approach the servicer if you need it for more time, but be prepared that the answer could very likely be no, we're not granting anymore. And let's talk about what you need to do. And first and foremost, super important thing, and a big reason we're having this particular call is don't default on the forbearance agreement. So if your forbearance terms expired and your first full payment's due April 1, 2021, do not default on that forbearance agreement. Pay that April payment. Let us help you get some additional or request additional time, but keep the loan current and don't default under that forbearance while you're seeking that, and know that that very likely may be enough. So we're going to talk in a minute about what your other options are, but do not let that forbearance.
I can't stress that enough. No. That's absolutely right. There have been a number of situations, as Ann said, where we're already asking for second round relief. And the only time we're getting traction on second round relief is if you're in compliance with the first round of relief. We've had a couple, 3 deals just recently where second round relief, the borrowers are not in full compliance, and in fact may be in default of that first round of forbearance. The answer is no. You defaulted. You didn't do what you say you're going to do. You defaulted. We're not doing anything else for you.
And in fact, here's what we are now going to do.
Yes.
We're going to say all those fees that we waived before, default, interest, and all that, well, now they're all due and payable. And by the way, they could have easily been guaranteed to be repaid by the guarantor. So beware that big number that didn't apply before could be due immediately. You're going to immediately be put into a cash sweep. Again, dependent upon your agreement. We're talking about what we are seeing in a standard agreement. If you were able to negotiate any of these things out, good for you. But just be aware that all those things could be lurking in there. They may be able, easy for me to say, they may be able to quickly go to court, put a receiver. And you may not have the ability to.
And in guaranteed amounts in certain states, California being one of the most notable, that they don't have to pursue foreclosure to execute on the guarantee. They can pursue, California is one of those states where they can pursue the guarantor directly without going through foreclosure. So the guarantors could be facing a suit, a non-deficiency guarantee suit. So if the numbers are big enough, it may make sense for them to do that. I'm not saying they're going to, but we don't know. We're in one of those situations where we don't know.
Right. So what are the options? And by the way, I think hopefully all of you saw enough, you saw this, but we're doing this very call every 30 days, 30 minutes. We're gonna on the next call talk to you about a few other options, but right now let me cover a few with you high level. We'll dig deeper into them, and by the next 30 days we'll know that much more about what the servicers really will do and really won't do, right?
Yeah, we are learning more every day
right.
about how we're going to handle this or how they're going to handle this.
One thing people are doing that are you're getting to the end of your forbearance terms, your property, and where this most applies, I gotta say, is probably hotels, right? So a hotel, let's use, there are some where you've got a conference center in downtown New York, or Chicago or other tougher places. It did not recover enough to, number one, even make a full payment by April of 21, let alone a payment and a half or 2 payments, right? So one of the things people are doing is going out and finding preferred equity as a source of bridging the gap between the length of your forbearance terms and your property recovery. That might be a year, 2 years, 6 months. I mean, whatever that gap is, that's where there's a lot of distressed capital out there looking for ways to invest in this market, and that's a way that they're finding to invest. So that's one way people are handling this. Another way we've seen people handling it is, let me sell the property. So if you don't otherwise have the money to bridge that gap yourself, servicer doesn't give it to you, before you hand the property back to the servicer, you might consider selling, because these are generally not property, they're not loan issues, you're not over levered in a normal environment. It's just, you got to make it through the, COVID recovery. What's another option? Another option is to, you can hand the property back. You can let them go through the foreclosure. But there really aren't a lot of really good options here, short of funding it yourself or bringing in extra money to fund it, or selling the property.
Now, the good part about the markets right now is there does appear to be a lot of sale equity, as well as a lot of, I want to call it rescue capital. Let's call it more of a distressed bridge capital, where not necessarily bridge loans, but the preferred equity situation, where we're seeing that a lot, where folks will come in and put 10 to 12% in, it's expensive, it's not cheap, but it is preferred equity, and it's generally term equity, not limited equity. So we're seeing more and more of that, and just to cover the cost of keeping it current, funding any shorter to medium term capital requirements. Because make no mistake, what you're being asked to do now and what you're going to be asked to do in the near future, those are capital contributions. I mean, it's fresh money. I mean, we lost revenue out of the markets. It's not coming back. Lost hotel nights. It's the money's got to come from somewhere. So we're seeing that a lot.
And where it really, really, really just doesn't make sense before you hand a property back. If your property was performing pre-COVID, well, we break it down into two categories, but if it was performing pre-COVID, but yet right now use the conference in New York or the conference center in Chicago, or big properties that are going to take a long time to stabilize, the COVID short-term relief of kicking the can down the road a year likely may not work at all, and you may need to actually have your debt modified. Not a forbearance and not a kick the can down the road, but a true longer-term modification that's subject to a modification fee and all that. But that's something we could certainly talk to you about.
And we are actually seeing more activity there, where servicers, now that COVID, they're buying into the COVID is about over, they're now willing to look at long-term situations. The worst situation you could have possibly been in is to be on the margin right when COVID hit. COVID hits and you couldn't get anything long-term done. You lost 15 months of getting this solved. You might be able to get it solved now.
That's a great point too. So if for properties that if you were on the margin or you just weren't performing previous, hotels in Lake Charles, hotels in Houston,
even Chicago.
Yeah. You weren't performing pre-COVID. You did have a long delay at getting attention because of the disruption of COVID. But now you can revisit those. And now we're seeing, again, I think servicers are thinking COVID's done. And that's really kind of
that's right.
That's where it stands. So we're summarizing this right now and getting ready to wrap up. It's 2:27. We are, number one, again, every 30 days, first Tuesday of the month, we're holding the CMBS 3030. It's to update you on everything we're seeing in the market, what we're seeing servicers do, not do, make sure you're fully prepared. And we're always willing and interested in talking to you about your particular deal offline. Will and I are available to do that at any point. So We look forward to hearing from you, and I think together we'll make it through this somehow, right?
Hang in there.
Yeah. Thank you for joining the call today.